talk about one of my favorite topics, non-recognition rules. So we're talking about property transactions, a very, very important area of tax. So remember, there's 3 rules when it comes to property transactions, 3 steps. First is to calculate the realized gain or loss. That's the amount realized minus the adjusted basis. That gives us a realized gain or loss. Then the next step is to determine the recognized gain or loss. Now, the general rule is that all realized gains and losses are recognized unless there's a non-recognition rule. And that's what we're focusing on in this topic. I'm going to go in more depth. The third, after you have a recognized gain or loss, which recognition is what actually makes a difference in terms of reporting on the tax return. If you have a recognized gain or loss in step 2, step 3 is to look at the character of the recognized gain or loss. We'll talk about that in another topic. We're focusing on step 2, the recognized gain or loss. Not the realized gain or loss, the recognized. So we've already calculated that realized gain or loss, and we're going to do that again in this topic, but we're focusing on the recognized gain or loss. Now, there's 2 common themes in all non-recognition rules, and you're going to learn a bunch of different non-recognition rules throughout your tax courses. In this class, we're going to talk about a few. We're going to talk about things like like-kind exchanges, involuntary conversions, and some other different types of non-recognition rules. But you're going to focus for a second just on what the commonalities are on all non-recognition rules. One of the things I love to do when I teach tax is focus on the themes, because they're going to help you in terms of remembering rather than have to understand 20 different rules. If you understand the themes, it really helps you manage the 20 different rules. Yes, you might still need to know a little specifics, but it helps keep in mind what that's all about. So non-recognition is not the same as exclusion of a gain or loss. It's simply a deferral mechanism. So a good way to understand this, and I've got my magician outfit on, got my hat, and I got my bright gold jacket, right, to provide an illusion. And I've got my wand, my magic wand. And the idea there is just like a magic trick. It doesn't really disappear. The gain or loss in a non-recognition transaction does not disappear. It's simply going to be deferred until the future. The way it's going to be deferred is that the non-recognition rule will always have a corresponding basis rule. Every non-recognition rule will have a corresponding basis rule. So keep that in mind when you're learning non-recognition rules. There's always a corresponding basis for the new property or new item received when in terms of that transaction. Let's finish by talking about what those 2 common elements are for every non-recognition rule. So the first one is economically, before and after the transaction, the taxpayer is in the same situation economically. And what that is for that specific topic is defined by Congress. I know that sounds a little crazy, but that's where the requirements come into play. But again, economically, before and after, you're in the same situation. Okay, perfect example, like-kind exchanges. You've got real property before, you trade it for certain real property after. If that qualifies and meets the criteria we're going to talk about in other videos, then it's going to qualify for non-recognition, and you get to defer that gain or loss that would have been recorded if you were to sell it for cash or some other property that's not like-kind and have to recognize that gain or loss. We're going to defer that until the future. How do we defer that? The new property received is going to have a basis that's been adjusted in a formula in a certain way that lurking gain or that not recognized gain or loss that would have been recognized is still inherent in the new property. So when it's sold later on, it will be recorded as long as it's in a transaction where the gain or loss will be recognized. So the first thing that all non-recognition rules have in common is that economically, before and after the transaction, the same as defined by Congress for that specific type of transaction. The second thing is that with respect to liquidity, the taxpayer does not have taxes or does not have cash to pay taxes. Now that's something that you would say, hey, but that could be subjective to the taxpayer. And you're right, it could be. So what's one objective way? Well, there's no cash that changed hands with respect to the transaction itself. If any cash changes hands, then it's possible that part or all of that gain or loss will be recognized. And a lot of times it's going to be gain but not loss. And you're going to see that. And we're going to talk about why that rule is. Anti-abuse it's called. We're going to talk about that. So again, the 2 commonalities, first, before and after the transaction, economically, taxpayers in the same situation. And second, taxpayer did not receive any cash to pay taxes in the transaction itself. And that's so important to Congress because you always hear stories of, oh, selling the farm or selling their business, and then, they can't pay the taxes, so they have to do so. You always hear this in the news and the media. So the idea is that Congress in times doesn't think it's right to tax the taxpayer at that specific time and instance. In the future, yes, but not now. So that's really what non-recognition rules are all about. Again, they're deferral. They're not exclusion. Exclusion, you would be making the gain or loss disappear. Deferral, it's like magic. It doesn't really disappear. It's just we're hiding it until later, right? Maybe I make the rabbit that I have here disappear, and really it's under my hat. So that's really the idea, is that it's an illusion. It's still there.